Good morning, you wonderful melonheads. Today is Thursday, May 11th, 2023. Regional banks back in the news today. Pacwest Bank is down big this morning. They just released an SEC filing that last week alone, just during the week ended May 5th, that Pacwest lost some 9.5% of the bank's deposits. Also included was the fact that they had borrowed nearly $10 billion dollars in order to fund that capital flight from their bank. And they're assuring us that all is well, that PacWest is fine because they're saying they've got available $15 billion dollars of balance sheet liquidity. And what they're not saying is nearly every penny of that $15 billion dollars in balance sheet liquidity that they have available to them is through the Fed's discount window, which is the lender of last resort. That is where desperate people go for money, and it's expensive. It costs over 5% to borrow money from the Fed's discount window at a time when you can only get 3.5% buying U.S. Treasuries. So what they're not saying when they say, yeah, we've got this $15 billion dollars in liquidity and we're fine because we can use that to fund any more deposits withdrawals. Well, what they're not saying is that money is so expensive it will bankrupt our bank if we have to use it. And so PacWest Bank is down big. A lot of the other regional banks are down right now. And we've got renewed calls this morning for banning short selling. JP Morgan CEO Jamie Dimon was on Bloomberg this morning saying that short selling of banks should be banned. Go figure, the biggest bank CEO in the world wants the government to make it illegal to short his stock. Funny how that works. Good thing Jamie Dimon's not in charge. He's also saying that people who short a bank and then tweet about it should be prosecuted. Yeah, that's right. Me and my little YouTube channel here. I'm an existential threat to democracy. Oh my goodness, what are we going to do? Yeah. By the way, I would just remind you guys that JP Morgan was labeled a criminal enterprise by the Department of Justice, citing hundreds of thousands of instances of spoofing precious metal trades across 10 years, that they rigged the price of precious metals, that they conspired to crash the silver squeeze. Jamie Dimon is scheduled to be deposed in the Epstein trafficking case over the next few days. So, yeah, short selling banks, that's the big problem in the world. Thanks, Jamie Dimon. All right, guys, with that, we are going to shrink my big melon of a head and let's see what's going on in the markets this morning. S&P 500 down 20 points and falling about 0.5% right now at 4,117. The Dow is down 239, about 0.71% at 33,291. Stocks not liking this news this morning. The Nasdaq's faring a little better, down only 15 points or about 0.13% at 12,292. Looking over at the DXY, we've got the Dixies up a little bit this morning, about 45 basis points at 101.93. Threatening to go back into that 102 territory. We're towards the upper end of that band, that 101 to 102 that we've been in for a while. My gut still tells me the Dixie is going to break higher from here if it bounces off of the neckline of that head and shoulders pattern. But again, it all depends on what the Fed does. Looking over at the bond market, we've got yields are lower across the board. People are dumping U.S. Treasuries this morning. We have got the 1 month is at 5.51, basically flat for the day. The 10-year at 3.36, down another 7 basis points. Yields just continue to fall. And, right here, folks, this is one of the reasons why PacWest is in such bad condition right now, because they need to go to the Fed's discount window and borrow at 5.25% in order to fund withdrawals right now. Well, if they are earning 3.5% or 3.3% in the U.S. 10-year Treasury, well, they're losing money on that deal. So PacWest is in big trouble here. Looking over at the commodity space, we've got gold is down about $1.80, essentially unchanged for the day at 2,035. Silver getting smashed, absolutely crushed this morning. I guess while Jamie Dimon is in the news saying we should ban bank short selling, he's got his metals desk is busy shorting silver into oblivion this morning. Currently down 78 cents or 3% on the day. Silver at 24.86. WTI crude resuming its slide down 87%. I'm sorry, not 87%. Down 88 cents on the day or 1%. Big difference, doesn't it? Crude oil at 71.64 this morning. All right, here is the big story in CNBC. PacWest shares tumble 20% after regional bank says deposits fell by 9.5% just last week. All right, in 1 week, Almost 10% of deposits were pulled out of that bank. And again, PacWest is funding these deposits by borrowing money. They're not selling their assets. They're borrowing. This is a desperate bank. And again, just Jamie Dimon would just love it if the government came in and forced me to not talk about it. And Jim Cramer was on CNBC this morning saying, oh, we shouldn't talk about this because then we're part of the story. Like, if the public doesn't know that banks are failing, maybe the banks won't fail. This is what legacy financial media is out there saying. Jim Cramer does not want to cover this story. It's the biggest story in finance right now. And Cramer doesn't want to cover it because it probably might be bad for some of his positions or maybe the people that advertise on his network. Shares of PacWest were under pressure once again on Thursday after the struggling regional bank said that deposit outflows resumed in the first week of May. The stock was down 20% in pre-market trading. Shares of PacWest were already down 40% this month and more than 70% for the year. I should note that PacWest had a rip-roaring rally over the previous few days on rumors that the federal government was going to ban short selling, and that created a short squeeze. But it looks like right now it's giving back some of those gains. The bank said in a securities filing on Thursday that its deposits declined 9.5% during the week of May 5th. PacWest said that the majority of those outflows came after media reports that said the bank was exploring strategic options. The bank also said that it was able to fund those withdrawals with available liquidity. PacWest said it now has $15 billion of available liquidity compared to $5.2 billion of uninsured deposits. And those are two completely irrelevant statistics, I would just add, because PacWest, we've got $15 billion of available liquidity. That is incredibly expensive money. That's like somebody saying, oh, don't worry, I'm not broke because I've got a $20,000 limit on my credit card. Well, the interest rate on your credit card is 30%. So, yeah, you're broke, bud. You can go borrow expensive money. That doesn't mean you have money. You're broke. And they're also saying that's compared to $5.2 billion of uninsured deposits. Look, I see this thrown around a lot, uninsured deposits. This is no longer just an insured versus uninsured thing. People have incentive, whether insured or not, to get their money out of these banks right now because they're only earning, a tenth of 1% in a savings or a checking account when they can be earning almost 5% in a money market fund. So regardless of whether insured or uninsured, banks are bad places to keep your money right now. They're risky because they're failing left and right, but there's also the fact that they don't pay enough interest. You can get more interest elsewhere. So it's this, we only have $5.2 billion of uninsured deposits. It is irrelevant, totally irrelevant statistic right there. They're making these non sequitur arguments trying to restore calm, but it's pointless. Looking over here, this is the actual SEC filing in question here, and I just want to read a little bit of this. On May 1st, 2023, First Republic Bank was closed by regulators and immediately sold to JP Morgan Chase. This event highlighted market and customer fears of additional bank failures, including PacWest. Our stock price declined approximately 41% from 10.15 on April 28th to 5.96 on May 5th. On the afternoon of May 3rd, PacWest was featured prominently in the financial news headlines with reports that PacWest was exploring all of its options and having talks with potential investors and partners. The news headlines increased our customers' fears of the safety of their deposits. During the week ended May 5th, our deposits declined approximately 9.5%, and that's the number that's causing panic right now, with the majority of the decline occurring on May 4th and May 5th after the news reports on the afternoon of May 3rd. PacWest funded this decline in deposits with available balance sheet liquidity, which means they borrowed money. How much did they borrow? About $10 billion. They borrowed roughly $5 billion each from the Bank Term Funding Program. That's the Fed's new word salad for lending money based on face value instead of fair market value. And they also borrowed about $5 billion from the Federal Home Loan Banks. Again, lender of second to last resort. PacWest Fund, okay, we already got that. Immediately available liquidity and going back here. On-balance sheet liquidity and unused borrowing capacity was $15 billion, which insured uninsured deposits of $5.2 billion. All right, so again, this unused borrowing capacity, that is their last resort money, and it is almost all from the Fed's discount window, which is the worst place to borrow money. Banks borrow from the Fed discount window right before they go under. All right, so they've already borrowed from the Bank Term Funding Program, about $5 billion. They borrowed about $5 billion from the Federal Home Loan Banks. By the way, they have pledged nearly all of their investment securities as collateral for that existing $10 billion in borrowing, and they're saying we can borrow up to $15 billion more, but the money is getting more and more expensive as they go. So that's what sent Pacwest tumbling this morning. Let's see where they're at right now. They were down as much as 25% pre-market, now down 28% at $4.33. And just on cue, we have got Gary Gensler, the stooge that's occupying the SEC chair right now. U.S. prosecutors reportedly looking at short selling in bank shares. And this one was published yesterday. I talked about this on my Patreon Zoom call yesterday. Federal prosecutors in Washington are looking into short seller activity around the recent volatility in U.S. bank shares sparked by the failure of 3 regional lenders since March. Short sellers, traders that profit by betting shares will fall, have come under scrutiny over the past week as government efforts to steady the sector have faltered and investor fears over the health of regional bank lenders have deepened. And what you're looking at right here, folks, this is stock market manipulation by regulators, all right? The SEC, the federal prosecutors, their job is to prevent the manipulation of markets for profit. And what they're doing right now is manipulating markets for somebody else's profit, namely Jamie Dimon, namely all the other bank executives, all right? Just the fact that this story was out there, that prosecutors are reportedly looking into a short selling ban and that they're looking into prosecuting short sellers, just that statement alone is enough to send these stocks higher. So the stock manipulation right now is being done by the regulators. I want you to let that sink in for a minute. The SEC chair, Gary Gensler, and federal prosecutors are actively engaged in the manipulation of bank stocks right now. Why? Because a decades-old easy money, zero interest rate policy has finally resulted in high inflation. And then to fight that inflation, the Fed created this monster of rate hikes that is failing banks. And right now the government is using every trick in the book to try to prevent these banks from going under, assuring us over and over again that everything is fine. Here's a question for you. Is Janet Yellen and Jerome Powell and Gary Gensler, are these people not actively misleading the public by reassuring us over and over again how safe the banks are, how resilient they are? Is that not a materially false statement being made in public for the purpose of driving bank stocks higher? Is that not securities fraud? And I just want to mention somewhere in this article down here, here we go. Last week, the American Bankers Association urged the SEC to probe significant short sales of bank shares that did not appear to reflect the issuer's financial status, which is terrible, by the way, including some that followed favorable earnings report. We have also observed extensive social media engagement about the health of various banks and the sector generally that appears disconnected from the underlying financial realities. So not only are they blaming short sellers who provide a vital market function, I might add. Short sellers are part of organic price discovery. But now they're blaming social media. Yeah, Jack and his YouTube channel, Jack on Twitter. I'm the reason banks are failing, right? Not Jerome Powell and his printing press, followed by Jerome Powell and his rate hikes. That's not what's failing these banks. No, it's YouTubers. It's Twitterers, tweeters, whatever you call it. Twitter, a twit, whatever. We're the problem, right? Yeah, so they're going to be coming for YouTube channels. Make no mistake, censorship and locking people in, that is what they're going to do. They're already teasing the idea. This might as well be a test balloon. They're floating it. They're using the press as a focus group to see how people would react to it. No, the problem is not social media. The problem is not YouTubers talking about bank stocks. If people shorted bank stocks because YouTubers were talking about it and those banks were perfectly healthy, then that would not be a problem because those short sellers would get wiped out. They would lose their money and nobody would listen to those YouTubers or Twitterers ever again. But the problem is these banks are not perfectly healthy. The underlying financial realities of these banks and the issuer's financial status is not strong and resilient. These banks are insolvent. The assets that they bought with the liabilities, our money, are not worth as much as they owe us, and these banks are insolvent and they're failing one by one. This is a central bank created fiasco, and they're trying to ban short selling and muzzle the public from talking about it because they know they can't stop it. Jamie Dimon is right there in the midst of it. So looking at a couple of other banks right now, we've got Western Alliance Bank is actually doing okay. They're up 1.5% right now. Metropolitan Bancorp, ticker MCB, they're down about 1.6%. And Zion Bancorp, they are down about 0.5%. So the other regional banks are actually handling this one pretty well. Pacwest at the moment down 24%. So things don't look to be that bad over there. Another story I want to warn you guys about: Blackstone is in talks with U.S. regional banks over lending. And I've been mentioning how pensions and retirements are going to be used as exit liquidity to park all this toxic crap so that the banks and so that the asset managers can get it off of their balance sheets. Well, now we can include insurance companies. This one in Bloomberg just this morning. Blackstone Inc. is in talks with regional banks about forming partnerships where they would make loans that the firm funnels to its insurance clients, underlining the growth heft of private capital's heavyweights in financial markets. The alternative asset manager is in discussions with lenders with between $100 billion and $250 billion in assets, the Financial Times reported. So what's going on here is Blackstone is looking to the banks, or the banks, I should say, are looking to Blackstone. Hey, we've got all of these loans that are not worth anywhere near what we hold them on our balance sheet for, but we need the cash now. So what do? Blackstone is saying, hey, you can sell them to my insurance clients and you can get your cash right now without crashing the price, and we'll leave people with life insurance policies holding the bag. That's what they're talking about doing. I'm telling you, folks, these big BlackRock, Blackstone, Vanguard, they will use our money, our pensions, our retirements, our insurance policy money. They will use it as exit liquidity to let the big dogs get out ahead of time, and they're going to leave John Q. Public holding the bag. Mark my words, this is going on behind closed doors. They're doing it here, not even behind closed doors, out in the open. And I mean, the story a few weeks ago about how Blackstone is starting a new real estate fund for teachers' pensions from all over the country. I can't believe nobody's covering that story. That's just about the most god-awful thing I've ever seen, and yet there it is. All right, elsewhere, we've got inflation is coming down still this morning. The U.S. PPI, or Producer Price Index, showed annual producer inflation in the U.S. eased for the 10th straight month to 2.3% in April, the lowest since January of 2021. And there you can see this is U.S. PPI. It's coming down fast, guys. Deflation is on the horizon. If the Fed does not turn the money printer on and lower interest rates very soon, we will see deflation. Elsewhere, we've also got initial jobless claims surging this morning. The number of Americans filing for unemployment benefits rose by 22,000 to 264,000 on the week ending May 6th. That's the most since October of 2021 and well above market expectations for 245,000. And there you can see initial jobless claims surging this week. This is after a few weeks ago that big upward revision. Oh, but remember, the U.S. economy added all those hundreds of thousands of jobs, right? Oh, before seasonal. How does that happen? How does the unemployment rate tick down? How does the economy add hundreds of thousands of jobs? And yet we get this massive surprise in initial jobless claims, probably because the labor market statistics, the unemployment rate numbers are bogus. So Jerome Powell appears to be getting his way. Unemployment will be ticking up very soon. Initial jobless claims are rising and inflation is coming down. And we get to enjoy all the good and the bad that comes with it. Another story going on today, I'm not going to talk about it, but Disney down 8.25% this morning at $92.90. Why? Because Disney Plus lost 4 million subscribers in the last quarter. I just want to emphasize that. 4 million subscribers. I just want to congratulate Disney for accomplishing something that people once thought was impossible. You have finally figured out how to lose money with Star Wars. Congratulations, Disney. You suck. Kathleen Kennedy needs to be fired. I just thought I would mention that. 4 million subscribers lost to Disney Plus just in the last quarter. Amazing. And I want to say a thank you very much. I saw you in here. Where's that super chat? Here we go. Thank you, Steve Woitis, who says copper at a 4-month low. Dr. Copper is calling BS on the strong economy. I did notice that one yesterday. You know, I know there's a lot of copper bulls. People have been watching the inventory numbers. I am not among the copper bulls. Why? Because copper is a very good barometer of the economy. Copper is used heavily in electronics, in vehicles. It's also used heavily in building construction for wiring and pipes. And I think copper is the perfect barometer of what is going on in the economy, and it's not good. All right. Also, lumber is tanking right now. Another indicator that, guys, there's trouble on the horizon for the housing market. I don't think the housing market will be what causes this financial crisis, but when this financial crisis does get here, the housing market will fall along with everything else. It's just inevitable. When we get widespread deflation, asset prices falls, and houses are the largest assets in most families' balance sheets. Thank you very much, Steve Woitis, for the heads up on copper and for the super chat, sir. You are a gentleman and a scholar. And my man, Eric from above my pay grade. What's going on, Eric? I had the pleasure of having a beer and a burger with Eric over the weekend. It was a good time. He was in my neck of the woods. Good seeing you, brother. He says probability that the debt ceiling isn't raised in time. Probability. I would still say it is a low probability, Eric. Like I would say less than 10% probability that the debt ceiling does not get raised in time. All right. I'm not going to peg it down to a number, but I'll say less than 10%. All right. But that doesn't mean that it's all clear, because although it is a low probability event, it is a very high consequence event. And risk is probability times consequence. All right. If it's a low probability but a high consequence, it's still a big risk. Just like if it's a high probability but a low consequence, it could still technically be a big risk because it's very likely to happen. So I'm not too worried about the likelihood of it happening. I'm more worried about the severity of what happens. And if the debt ceiling doesn't get raised, we are looking at a spike in the DXY that we have not seen in a long time. That will send asset prices plummeting. That will send interest rates skyrocketing. It will result in a global dollar shortage. And that's why I worry about the debt ceiling. By the way, even if the debt ceiling does get raised, we may see that scenario play out anyway, maybe to a lesser extent, because what is Janet Yellen going to do just as soon as the debt ceiling get raised? Janet Yellen's going to go borrow hundreds of billions of dollars at a time when liquidity in the bond market is already tight. So Janet Yellen dumping hundreds of billions of dollars in treasuries onto the market is going to soak up all the liquidity in the bond market. So it's going to cause maybe less so, but a dollar shortage and higher interest rates. So even if the debt ceiling does get raised, that's not necessarily in all clear. Thanks again, brother, for the super chat. And it was a good time hanging out this weekend. Check out Above My Pay Grade on YouTube, folks. And where are you in here? I see one more. I'm going to find you. There he is. Thank you very much to the inflation situation. He says, thank you, brother. I better support you while I can. You're spot on. RE financial censorship justified as a national and economic security protection. Look, every curtailment of people's freedoms that has ever happened has always been done in the name of the greater good. And that greater good yet remains so elusive, doesn't it? Think about all of the infringements on freedoms and freedom of movement and freedom of speech of the last few years. We should be swimming in greater good right now. Where's all this greater good I keep hearing so much about? They locked us in our houses. They gagged us. I don't. You got any greater good over there? You guys let me know. Let me know where your greater good is, because I sure as heck can't see it. Anyways, thank you very much, inflation situation. I agree, financial censorship is coming. Hey, in the meantime, until they censor this channel, won't you please like and subscribe while you guys are here, because I just love doing this every morning, talking to you guys. Thank you very much to my Patreon supporters for everything you guys do for the channel. There is a link down below. Thank you guys for watching and for all the super chats. I really do appreciate that. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.